Hey everyone, I'm Roger Herring. I'm the investor's accountant. Welcome to another edition of Ask Roger. This is where you get to ask me a question about growing wealth, about real estate taxes, about taxes in general, and how we can avoid taxes to keep our money multiplying, which is where it belongs anyway. So today, the question comes from Facebook, and a gentleman wants to know, are there actual ways that we can grow wealth tax-free? Yes, they are. In fact, there are three different buckets. You may have seen this example before. You've got a taxable bucket, a tax-deferred bucket, and a tax-free bucket. And you can actually move from one bucket to another. Well, how do you do that? Let's go to the whiteboard and find out. Okay, gang, let's draw this out so we can visualize it. I told you, you've got three buckets. All right. 1, 2, 3 buckets. Now, there's actually a fourth bucket, but that's a little bit beyond today's discussion, so we'll leave that for another day. The first bucket is your taxable. All right. And what comes in this bucket? This is everything that hits your 1040 or your tax returns, but you're paying tax on. If you're a C Corp, you're 1120, et cetera, et cetera. So, but this comes down to, this is your W-2, your interest income, your dividend income. What else? Capital gain and rents. Now, I'm going to put a little star right here. We all know that a real estate pro has a strategy that they never have to pay tax on their rental properties, and that they can take the losses and offset their other income. And those losses are only losses on paper. They're not real. But it is a 1040 item, so we're just going to leave it right here for right now. Okay? Now, we have a tax deferred. And what comes in here? Traditional retirement. Okay? Traditional retirement. And what is that? That is your 401k. That is your IRA. That is your SEP. Maybe it's your simple. That's a P, not a D. Try that. Okay. And there are insurance products out there that I'm just going to mention because it does fall into this bucket. Annuities. Then we have the tax-free. And down here, what do we have? We're talking Roth. And that comes in the flavor of a 401k. It comes in the flavor of an IRA. Starting this year, it includes SEP. Yeah, how about that? And there's a couple of other items that fall in here. An investment item is municipal bond, what we call munis. And in the insurance world, they use cash value life insurance. Okay. I'm just mentioning munis and cash value life, just like I mentioned annuities. We're not really going to get into that at all today. All right. So here we go. What we want to be able to do is move money out of this taxable bucket into the tax deferred. Okay. And we want to be able to leapfrog over the tax deferred and come down here to the tax-free. Now, I got a few little characteristics, we'll call them, that I want to mention about each of these pots of money. The taxable, this is a pay-as-you-go method. Okay, pay-as-you-go. The problem with pay-as-you-go is it has slow growth. Here's an example, okay? If I've got $10 and I get 10% on that, I made $1. That means I now have $11. Yay me. But that $1 is subject to tax. So $11 minus a 20-cent tax, I now have $10.80 to keep growing with. Okay. Whereas over here in both the tax deferred and the tax free, the growth rates are different. So in the tax deferred, this is pay at the exit. You're going to pay when you're done. You're going to have faster growth. So that same $10 times 10% is $1. Okay. I now have $11. How much tax do I have? 0. So I am still making compound interest on my $11. Okay. So faster growth, pay at the exit. Now, the tax-free has the same faster growth. But obviously, the money that is here at the pay at the exit, one day I'm going to have to cough up the dough. Over here, I never pay. So it is also important not just to move money to tax deferred and leapfrog tax deferred. Whatever we have in tax deferred, we want to get over here into tax free. So let's talk about first, how do we defer money? Well, you already know that. You make an IRA contribution, a SEP contribution, you make your contribution to your 401k. If it's a solo K, you've got a whole lot larger limits than if you're working for somebody else. Or if you have employees, you can't have a solo K, but you can have something called a safe harbor 401k. All right. But we're really not getting into those. The main thing to understand is deferring income from your paycheck and putting IRAs in place is how you get money into tax deferred. Now, how do we go from taxable over to tax free? How do we leapfrog? Well, we can do a Roth 401k. That's the first option. Okay. And here's the new thing. There is a new law that came out in December of last year that says the employer match can be Roth now. The problem is nobody in the industry has the software set up to be able to handle that. So that's kind of on hold for right now. So if you are making contributions to your 401k and you are under 60 years old, I normally recommend that you forego the deduction. Why? Because the tax-free growth is worth a heck of a lot more than the deduction is. Okay. Now, sometimes if you're over 60, it's case by case. We need to take a look at it. But sometimes if you are under 60 and you have a specific circumstance, we might want to contribute to traditional. We want to make common sense. Let's talk about my friend that messed up and made $800,000 this year. He normally makes about 120. This year he messed up. He had an event. He made $800,000. He needs some write-offs. So what did we do? We made the 401k, instead of his normal Roth contribution, we changed it to traditional for this year only. Why? Because he is now in the top tax bracket, 37%. Ouch. Next year, he's going to be back to his 120. That's only a 22% tax bracket. Okay. 22% tax bracket is much better than 37%. All right. So here's what we're going to do. We are going to now, when he's in the 22%, take that traditional contribution. Oops, my eraser is on. We're going to take this traditional contribution and we'll convert it to Roth. And he saves the spread between the 22 and the 37, or a total of 15%. Okay. That's what we do. Now, normally we would just go ahead and contribute. If you need the deduction, You can take the deduction like my friend did, but down the road, you're going to need to convert it. Okay. Now, before we talk about conversion, let's also talk about something called a backdoor Roth. Now, Roth has specific rules and income limits, but the thing is, they only apply to contribution. Roth has no income limits when it comes to conversion. So let's say that I want to do a Roth IRA contribution. I make too much money. If I'm under 50, I can do $6,500. What I want to do is make the contribution to a traditional IRA, and I want to do this as an after tax contribution. Okay. It's after tax. Now I am going to immediately convert it to Roth. Now, here's the issue. If I have other IRAs over here, these IRAs will lock the back door. What I need to do with these IRAs is roll them to my 401k in most cases. And that will unlock the door. Okay. So we know how we get money into tax deferred. We know how to leapfrog with a 401k or a backdoor IRA. All right. But how do we move money out of tax deferred into tax free and not get hurt? Well, we've got a couple of strategies. All right. The first strategy is called matching. And what that means is I am going to create a loss. Roger, I don't want to lose money. Don't worry. This is a loss on paper. Now, there are a number of tactics for doing that in both an ordinary income company and with investors. Let's talk about one of the most common for my real estate pros, and that would be a cost segregation. This is where they break out, they do an engineering study, and they break out the components of the house from the house. And we're allowed, because of bonus depreciation, to have a big upfront write-off. Let's just say our write-off that we did was $80,000. Now, I can reduce my taxes by $80,000, or I could convert $80K from traditional 401k or IRA for that matter to Roth. This is a loss of 80K. This is income of 80K. The two net for a tax effect of zero. And now I've got $80,000 in Roth growing tax-free forever. Okay. There we go. Okay, guys, the next strategy that we have is something called chunking. And this is a strategy that's going to let us convert over time to Roth. What we're going to do is we're going to take advantage of the 12, 22, and 32% tax brackets. Why? Because they are long. So what we want to do is when we are in one of these brackets, we're going to take our income from where it is and convert the difference between the top level of that bracket and our income to Roth. Here's an example. Let's just assume that I am in the 32% bracket. The 32% bracket runs from 182K to 231. Okay. And let's just say, to make math easy, I made $200,000 last year. Well, that means I've got a spread before I hit the next tax bracket of $31,000. Okay. That means that I can take $31,000 from my traditional and convert it to Roth and still be in the 32% bracket. Okay. This is not a tax-free instance like we have up here with matching, but over time, this will work for you, especially if you have years where you're down in the 12 or the 22. All right, guys, let's close out the whiteboard and we'll head back over to the main camera and we'll close this up. There you have it, gang. I hope you have enjoyed this, and let me encourage you, get as much money into that tax-free bucket as possible. If you are younger than 60, it is to your benefit not to do traditional contributions. It is to your benefit to do Roth contributions to your 401k. All right, until the next time, guys, can't wait to see you again. Roger out.